Our panelists are in the back of the room. They've been pacing. They're ready for action. Here they come, led by Matthew Gamser, CEO of the SME Finance Forum. Also joining him on stage is going to be Peter Cowley, of course, well known to everybody here from last night, all day yesterday. He's going to share some more of his insights with us, a UK Entrepreneur of the Year 2013, 2014. And a fresh face on stage, Dogan Tazkent. He got started studying at F University, which I'm pretty sure had nothing to do with Ethereum because it was more than a couple of years ago, but you know, we'll take him for that. He is a partner at Archer and Ergen Corporate Finance and a board member with the Swiss Chamber of Commerce. He's a real community guy, whether, you know, wherever he studied, he's been involved with the alumni forum, or started the MIT alumni group here, so a real community guy, but also a successful business person and investor. Matthew Gamser, the floor is yours. Please.
Thank you very much, Andrew, and good morning, everybody. We're one more panel on the same topic, which we've been talking about all morning. So we're going to try to be interesting for you and maybe cut at some different angles. And I'm a CEO, but I'm not an angel investor, and I'm certainly not an expert in anybody as angel investors. And one of the things I was talking to Peter about as we were preparing this panel was, well, hang on. I thought all angel investors were people that had built companies and therefore they must all be CEOs. So why are we having this day at all? And Peter explained to me that actually it makes a lot of sense to have this day. So Peter, why is this?
Yes, so that's an interesting misconception you had there, Matthew. I'm not sure why. So I've been an angel investor only for about 10 years and CEO before that for probably about 30 years before that. And I'm chair of a group in Cambridge, UK, which is probably the best known in the UK and quite well known throughout Europe, called the Cambridge Business Angels. And our membership criteria are that you've got to be an exited tech entrepreneur. So i.e. you've built a business, so you know what it's like to build a business and you can add lots of value. However, even saying that, only 70% of us are. The other 30% are money men, people who've made money in the city, etc. If you go to the wider, and obviously I know more about the UK and other countries, if you go to the wider number of angels, ignoring crowdfunding, because who knows what they're doing, you've probably got about 10 or 20,000 offline angels. And I would doubt that more than 5 to 8% have built businesses themselves. That's not to say that people who don't build businesses can't help. And they can certainly help more once they've helped being angel investing for a while because they'll have followed journeys and helped. But it isn't, certainly in the UK, and of course it may be quite different in other countries, and I'm sure it's similar in the States, you don't need to have been a CEO. However, just the final point before I hand back is that an angel, as was said earlier by Peter Jungen, for those who are in the audience earlier on, is money is actually number 3 on the priority list. So it's help is number 1, then connecting, etc. So if you have been a CEO as an angel, you will, by definition, be able to help more and better, providing, and there's a big proviso here, you don't overstretch the amount of pressure you put on the founders with their own interpretation, which was mentioned earlier on, actually, by Paul.
Very interesting. Now, Dogan, you both, as in your role with the Swiss Chamber of Commerce, you're dealing with a lot of CEOs of very large companies, but also you also have a role in the whole startup ecosystem in Turkey. What's your take on all this? What do you see as the potential for CEOs here, and what do you see as some of the major issues facing getting more CEOs involved in the angel scene?
All right. First of all, thank you. As you said, I have been involved with CEOs and with the large companies, but on the other side, dealt the last 7 years over 2,000 startups and mentored, I believe, over 200 startups. And one of the issues I observed, as Matthew said, is money is nice. Of course, there's a fancy word, the smart money is more critical, but I would like to open that. Investing in a startup is like investing actually as a financial instrument. But we have to separate that, because if you invest in a regular financial instrument like a bond, you put your money and you observe. Whereas when you invest in your startup, and you just put the money and observe, likelihood that that money will not go anywhere is high. So hence, you have to invest your money and put some complementary assets into it. What are those complementary assets? Those are your experience, knowledge, know-how, how to do the thing, connections, how to lead in difficult times and build a company. In fact, those complementary assets made you a CEO at the first place. So as a CEO in your invest, if you just put money and not your complementary assets, you just put one thing and not the other part. However, when you invest in a startup, startup is another startup. They go through stages. You should look which stage you can leverage your complementary asset most. It's very early page when you create the idea and look product market fit, or developing the product, or just before going to the market, or after the market entry. I mean, your complementary assets also not covering everything. It's also focused on certain area. So as a CEO, with your right complementary asset, choosing the sweet spot of the startup would make the major difference. When we look Turkey in this region, we see mostly money investment and no complementary asset, or they invest the money and would like to have almost full control. Of course, this is the opposite side, which Matthew mentioned before. It's a catastrophe. So there should be a well-balanced approach. Obviously, money plus complementary asset, but in proper dosage, and not you are not the CEO of that startup.
Okay, so this is very interesting. So you, the primary asset is the experience in the angel equation. But unlike in a venture capital situation, you're not taking an official controlling stake. And for CEOs, that must be hard, because you're used to being in charge and making decisions.
Yes, in fact, again, I can't speak for every country, but certainly in the UK, there are, like there are with any investment, there are investor consents and shareholder consents and investor director consents. There is a level of control that you have there. I mean, for instance, just issuing a whole load of new shares, clearly the shareholder base needs to ensure that. But there's a lot of other things that are down to things like not paying too much for salaries, etc. So there is a level of control there. But there's a great difference between that and acting as a coach or mentor and supporting an entrepreneurial team, particularly if they're young, and taking the same level of control as you would do if you're running a big corporate.
So it's more about how are you effective in influence as opposed to how effective you are in command, which is not the same skill set necessarily. So how do you tell what CEOs are going to be able to make that jump to a different role, and which ones are not going to be comfortable if they can't call all the shots?
Well, that depends at what point you're having to make that decision. So if you were an entrepreneur and I was having this conversation, I'd make sure you did plenty of due diligence on me and the other investors coming in to make sure, A, that we're going to behave well at all stages, and B, that we're not going to be the sort of, let's use the word bully, which is slightly unfair, but there are people out there who are quite strong in their opinions, and you're not going to get one of those in the shareholder base, but more specifically on the board, because it's the person on the board that's representing the shareholders that's the one that's going to have the most influence over the entrepreneurs.
That's also interesting, because I also think back to, I mean, this is a very nasty, stereotypical image of VC, but you know, the VCs, you see a great idea, you come in, you take command, and next thing you know, you fire the CEO, or, you know, or put him in some subordinate role, and you bring in somebody that's your person because they're going to march to your tune, and that's definitely not what we're trying to achieve with CEOs in angel investment, right?
But the opposite of that, and I often see this, is that angels can be too soft. There's a term which hopefully the room has heard, which is hire slowly, fire fast. This is for employees. Get rid of somebody who's not very good as soon as possible. Clearly, you don't want to be doing that with the CEO, but you will get to the point, if that goes wrong, you can end up losing the CEO. What experience have you had?
Here is the involvement is less, and therefore I don't see a problem. So the angel investors, CEO angel investors, first of all, we don't see many CEO angel investors here, but involvement is less, I would like to say. So it's not going in, as you mentioned, like the VCs firing stuff. So we don't observe that, and so I would like to give that.
Okay.
So, but when you do have, I mean, I know you don't have quite the level of VC investment here, but when you do have VC investment, is it a common case that they do come in and just sort of toss management?
No. Because even VC, when they enter on the early stage here. So this environment is still a developing environment, and because we don't have necessary angel investors count in this country, the VC investment penetrating in the angel investment environment as well. So with VCs and or angel investors, we are all here to build a functioning company. So we are at the building stage and not optimizing stage. So we need the visionary entrepreneurs that start the whole thing. In the later stage, you optimize it to the environment, but we need the visionary and the person that leads from front. So we leave the entrepreneur where they are.
That's certainly true in many of the more developing worlds in angel investing, is that the VCs are replacing angels because there aren't enough angels there, and they are behaving better. I totally agree with that. We've got the situation in the UK where VCs have had to come down markets in order to sit at the table for the good deals, and then they do behave quite differently if they're writing a check for 250 or 500k or even 150k compared with writing a check for 3 million.
That can be humbling. At the same time, if we look at the other side of this, the founders of companies, especially if they're now getting offers from potential investors, they have to be sort of proud, directed people. Do CEOs have a different advantage to, say, a general financial investor in coming in and finding out a way? Because sometimes people with those strong vision and direction and pride are hard to influence.
Well, there's two questions there. One is whether they can choose the entrepreneurs better because they've been good manager and they've built teams, etc., which they probably can do. Because choosing an entrepreneur, and again, this is addressed to the angels of the room, there's an awful lot of gut involved. You know, as Peter says, 70% fail or don't succeed. You've got to work out which, as I said last night on stage here in this room, you've got to decide which frogs to kiss to turn into princes. And the CEO's got a better ability probably to do that as they built teams. But the other issue, of course, is this involvement, isn't it? That if they get involved as a CEO using the knowledge, experience, connections, and all the other things we've talked about this morning, then they're going to be a better value investor, and therefore they should be chosen over dumb money. But as I was saying earlier on, dumb money actually, if you have a round which is syndicated, and I very strongly advocate having multiple angels in the round from experience, then having a level of money that's not actually adding any value doesn't really matter because it's bulking the round up and giving more runway. What you don't want to do, and very difficult to find, is to have toxic money. So this is money where it's actually detracting value because they're difficult to work with, they're bully, there are bullies around, there are bully shareholders around, etc.
But it can be hard for a young entrepreneur to distinguish sometimes, particularly when the bullying money comes with maybe a more attractive valuation, right? I'm going to give you this, but I'm going to take a lower percentage.
Usually the bullying money comes with a lower valuation because they know how to negotiate. The higher valuation tends to come from the super dumb money, which is the crowd.
Interesting.
I would like to also, as I mentioned, it's critical to bring the complementary asset, I say, because those are the things we accumulated over time as a CEO. That's fine. But there is a paradox at it, because the startups are looking for the future. They catch something that entrepreneur, in fact, caught something that we don't see, and he builds the company for the future. All our complementary assets actually from the past. So yes, we need all the complementary assets to do some basic needs. Okay, not everything changes from past to the future. Not to make the same mistakes, but we have to be very careful as a CEO. Our accumulated knowledge is the past decade's knowledge. And those guys are looking for the future. So yes, we have to help them out with our knowledge, experience, and networking and everything. But it could be from the past century. So we have to be humble, bringing that knowledge and that experience in it. And I would like that.
So given that, I mean, to what extent is domain knowledge an asset or a liability? If one of the key things is to respect the way that the entrepreneur is taking things in a new direction, is it helpful for CEOs who become angel investors to venture beyond the industries they know well, or is it better to stick with where you've been?
I mean, if you look at a soccer game, a football game, a CEO is actually with the knowledge, it's a great defender and goalie. It stops to making mistakes, okay? You don't get goals. To go forward and score goals, you need the entrepreneur. So entrepreneur is the attacking, the visionary, and with your knowledge, you support the company not to get beaten up.
Yeah, but of course, some of the best managers in football were not the greatest players. I mean, with all respect to Mr. Zidane, I mean, you know, you look at the fellows that are really consistently winning, and they were not necessarily the superstars.
Correct.
And maybe that's because of the danger. If you were so much at the front, you can't allow another one to share the vision.
You're unlikely to be investing if you haven't got some domain knowledge. I'm invested in only one therapeutics, for instance. I'm an engineer and software writer from training. And the reason I've invested in them because of the team, stellar team. So generally, angels will invest in something they understand. So if it's an angel that's also going to be helping with the journey, that domain knowledge in general is good because they've got, even though it's in the past, they know the connections, they know what went wrong, etc. What they mustn't do, and this sort of covers all this topic, is not assume when you're investing that you may be the customer. So, for instance, a B2C, something. I mean, can you imagine me, well, it can possibly me using some apps because I'm quite geeky, but there are a lot of things that the millennials might use as customers that I wouldn't dream of myself using. That's not the reason. Not knowing anything in that domain isn't a reason to not invest. You back the team.
So you could still invest in first player shooter multiplayer games companies, or
not me.
Listen, the audience has been sitting very patiently, and I didn't hear too many opportunities to ask questions before. Do we have any questions already through the system? I can't, oh, maybe I can see here. Do CEOs look for different, is this from this round, Andrew? Do CEOs look for different things in entrepreneurs than experienced angel investors, given a corporate background? Have you seen this as a barrier to making good investments? Anybody want to take this?
So do CEOs look for different things?
Yeah, would CEOs have a different vision when they're trying to select companies?
I would think so. Though, bear in mind that all angels generally have had some sort of career, obviously, unless it's just family money. So they've already probably been managers. So, and what's the difference between a manager of a division and a CEO? Not a huge amount. It depends on the size of the business. So most people, in the end, it comes back down to the fundamental thing that you're backing people. You're not backing a product or an idea. They've got to have that, clearly, otherwise you wouldn't be talking to them. But it's people. And if you can understand people better, whether you've been a CEO or a senior manager, which you probably have been if you're an angel investor anyway, then it's all comes down to interpreting your feelings about whether they can execute on what will be a very, very rocky journey.
And the same people skills are presumably one of the key assets in that non-financial
Correct.
support.
Whether it's you're CEO of a business or you've built yourself up to be senior management position.
I would like to add one thing to, as a CEO, I was mentioning beforehand when we talked outside, that as a CEO, you work with the officers. You have your different managers, and you have, like a military, CEO is a general and deals with the officers. When we look at the startup, this is in fact a commando group run by a sergeant from front, and it's out there to break the rules. There is no rules. There is one rule. There is no rule. Practically go and destroy everything what you have, and find a new position to establish yourself. On the other side, you have so many rules and lines that you need to operate with as a CEO. It's a whole different mindset, and we have to break that. And another thing is, of course, as a CEO, you drive a large track. And it's difficult to move, and your decisions are done maybe bi-yearly at board meetings, whereas the startup is a small go-kart. It can turn around very fast, even go to the wrong direction. Who cares?
So you're suggesting that one of the things that CEO angels have to watch out for is if you're too comfortable in hierarchies and you're used to only dealing with a small fraction of the senior command, this may not be the best strategy for operating with startups in a very fluid, dynamic market and company situation.
And they expect also, I mean, if you do a certain strategic businesses, joint ventures as a large company, as a CEO, you manage that because you have a brand name. I mean, you're a CEO of a company, has a certain brand, certain history, certain credibility. Things happen often easier. As a startup, you have no history, no brand name, no nothing, and still you need to establish those strategic joint ventures. And it requires different capabilities, different way of approaching. So those are different worlds. As I say, it's your know-how, your complementary assets are very critical for success when you invest in a startup, but you have to be very cautious how to use it. It's a different world, different operations. The guys out there to break the rules, and you run by the rules. So two different worlds.
So we heard earlier about the idea of forming a network of CEOs to try to go through some of these potential pitfalls and do some peer-to-peer capacity building. What do you think of this idea, and what would you do to try to...
I've just realized there's a misunderstanding between CEO of a company that's been started up by somebody and CEO who's been brought in as a senior manager. When I've been talking about it, I've been talking about CEOs who've worked their way up from being entrepreneurs, adding the value. If you've come in as a MBA, apologies to anybody with an MBA in the room, and come in through being trained to be a manager, you haven't seen that. You haven't seen the agility that's needed, etc. Whereas the sort of people I work with, co-invest with, have all seen that. They've all had to clean the toilets on day one because nobody else will do it, etc. So yeah. But in terms of what you were just saying, grouping together whether these CEOs are people who've built their own businesses, as we saw on the video earlier on, or they're people who've effectively come in through some route. You came through management consultancy. You must have been, you've been trained to be a great CEO, but you haven't actually taken the risk on your way through, have you? So. The sharing of knowledge amongst them, particularly between CEOs who built businesses and CEOs who haven't, if there is a distinction there, it will be hugely valuable. Getting them in the same room, getting them to understand the mentality of each other, the sharing, etc.
That's a really interesting point, because I do know a number of, I would say, incredibly capable professional CEOs who have jumped from company to company because they've been headhunted, but they never built a company. And they would be they'd come with a different skill set than, as you say, a CEO who spent a career either moving up in one company or building a company. And maybe even those last two are different. If you built the company yourself versus you started in the mailroom and you made your way up to the top. So creating that group of people with mixed backgrounds, there's a lot of potential to share experience, do some hole plugging,
which case, I don't know if Baybar's in the room, but maybe this should be built into the model here, that there's a mixture of different sorts of CEOs, that the term CEO is possibly not appropriate, that they've got to have categories of CEOs who can share from each other, because somebody who's been a senior manager all the way through and has probably dealt with the city on IPOs has got skills that are actually really useful for some of the other CEOs, even though they haven't been through that.
Very interesting. Do we have others from, I don't see anything else on anybody else want to raise your hand and ask an old school question with a microphone? Yes. You've been very good audience, so you deserve a chance to get involved. Everybody's being very shy. We're having a great talk here, and I'm happy to keep it going, but you all are welcome to join in. Don't feel shy.
Yeah. We could talk about the motivation of CEOs to become angels, if we want.
Yeah, I mean, what do we do to get more CEOs to be angels? Why are most not willing, and how do we fix that?
Yeah, I mean, this sort of stretches something slightly on the talk I gave last night about governments, but ignoring what I said last night, what somebody who's become a CEO that built their own business is used to taking risk right from day one. Now, that might be a journey that's only 3 or 4 or 5 years. It might be 40 or 50 years. They understand that. And being an angel is super risky. As Peter said earlier on, we're saying the whole time, unless you have a big portfolio, and Peter mentions 30, I mentioned 15 as absolute minimum, you're going to lose a proportion of your money. You're not even going to 1x return on that. So you've got to understand risk. If you take the CEOs come in through MBAs and high level, the risk they're taking is actually different risk. It's risk of possibly, to be rather candid here, the risk of their bonuses being lost, their brand being lost.
Your golden parachute as opposed to your life savings.
Exactly. You're not going to go personally bankrupt over it. That is a different feeling about risk. So convincing those sort of CEOs to be able to assist in the way we're talking about, and also to become angels. I mean, they may say somebody's got a capital base of 50 million. Putting $1 million of that is not going to affect their lives in the long term. They still make valuable angels because A, they're putting capital in, and B, they have experience. But they're a completely different angel from somebody who's built a business.
And that could be a very interesting dynamic between the entrepreneur, who's obviously got much more at risk, and the CEO, professional managerial CEO angel, who may not be quite used to the same level of risk. And educating, but as you say, there are skills that are very useful in those CEOs too. So finding the right way to encourage that skill set into the game is equally important.
The connections particularly, I mean, the CEO's been high level in industry, if they're in the same domain as, which I say is usually the case, we'll have the first phenomenal connections. For instance, we got one recently, a board I'm on, we got the guy who used to run Thomson Reuters, Tom Gloster, came in, and that was only because of that connection. So he's now an investor, and Thomson Reuters may well be the exit partner of this business, who knows, but he knows exactly who to contact there.
That's right, and even on issues like access to markets, it can be very, very useful, particularly if you're trying to broaden your geographic market access and you've got someone who comes from a much higher level corporate background in the field. Well, we are now 1 minute over time. I'm looking at our MC. We're 1 minit over time. You want us to wrap up?
Yes, sir.
He does want us to wrap up. So this has been a really interesting talk to me. We've had a great little chat, and hopefully you've enjoyed it too. I'm going to hand back to Andrew now to tell us what to do. I think we're going to have a break, right? No, we're not going to have a break. Sorry, don't go anywhere.
Don't go away. We've got a really interesting, quick 10-minute talk, like a little fireside chat. But first of all, let's have a big thank you to Matthew Gamser, Peter Cowley, and Dogan Tascan for joining us today and sharing their insights. Always leave them wanting more, Matthew. There you go. Thank you very much.